Why is there such a debate on dividends versus buybacks? Dividends are so much clearly better. No wait, buybacks.
A quick scan of Google will likely make you even more confused. Some articles say 4 reasons investors like buybacks. The dividend share buyback debate. Are buybacks better for investors than dividends? Cash dividends versus share repurchases. And why dividends are better than share buybacks. All these articles seem to suggest that the two are different. So what is a dividend? A dividend is a payment made by a company to its shareholders. It is paid equally to each shareholder. Let's give an example. If Google had, say, 100 shares, and it paid $100, then the dividend would be $1 a share. Each shareholder would receive $1. You would now have $1 extra in your bank account. Say there were 1,000 shares, then that $100 over 1,000 shares would only be a 10-cent dividend payment, and you would only have 10 cents extra in your bank account. That is assuming you still only owned 1 share. If you owned 10 shares, then you would still have that $1. Now let's move to what is a share buyback. We will just define it briefly here and show a mathematical calculation at the end, since it is a bit more complicated how it works than a dividend. A buyback is when a company repurchases and cancels its shares. Certain shareholders sell their stock, while others remain, but the ones who remain own a larger percentage of the company.
Well, you have probably heard your uncle or someone tell you that buybacks are scams, or you may have even read an article. Let's try to evaluate the claim. And which one do you prefer off the bat? Put down which one you think is better before we start the video. A, dividends, B, buybacks, C, you think they are the same thing. This video will explore, and we'll give you the conclusion right off the bat, that dividends and buybacks are actually the same thing, assuming there's no taxes. So there's actually no difference pre-tax. Let's start and give a theoretical company who makes $100 a year, and its discount rate is 10%.
Are you still listening? Okay, good. So let's start with that theoretical company that has a discount rate of 10%.
Oh no, what is discount rate? Well, let's just quickly explain what discount rate is. It's a fancy word of saying risk. Or said another way, what return would you need to be compensated to buy this investment over, say, another investment such as a US government bond? The US government bond is considered a risk-free investment, though this investment requires some return as you need to be compensated for, I guess, the small amount of risk that the US government has. The question then becomes, what extra percent would you need on your investment to be compensated for not making an investment in the US government or the risk-free investment? The answer would be a mathematical calculation. For example, if you were to pick heads or tails and bet $100, you would probably need, if you bet $100, a return of $100 to consider making that bet. However, what happens if you rolled a dice and you pick the number 1? Instead of requiring a $100 return if you bet $100, you might require 500%. Or 6 times your money. The odds of you winning can be thought of as the discount rate. This is how you can see the difference in what you would invest in. For a company, you could maybe think of it as bankruptcy risk or chance of getting your payment. So if you were to invest in a US government bond for 5 years and the odds of you getting your $500 at the end of 5 years was 100%, and the odds of getting $500 for a stock you invested in was 50%, then the value of that stock would be $250 and you would want to buy it at $250, not $500. So that is just a rudimentary way for you to think about discount rate. Okay, now that that's been explored, let's say this company has 10% risk, meaning that every year you need to make 10% return on this investment. So if you had $100 at the start of the year, you would need to be paid $10 at the end of the year for it to be worthwhile for you to be in this investment. The formula for what you would want to buy this stock or investment at is in the annuity formula. We will assume no growth for simplicity. However, you can watch why the value of future cash streams equals this formula in our video here. In the video, we did a growing annuity formula, which means your payment grows over time. But for simplicity, we're just going to use the annuity formula because it's the same thing for how a stock is valued. Whether you get $100 a year or that $100 grows at 2% a year, so next year it'd be 102, the year after it'd be 102 times another increase in 2%. Let's just keep it simple and say the payment every year is going to be $100. Since we said the payment each year is $100 and the risk is 10%, the value is $100 divided by 10%, or $1,000. The company, the stock, or the investment in total is worth $1,000. For a stock, this is what we call the market cap. However, what is the value at the end of the year? We said the company earns $100 every year. So at the end of the year, it's still going to earn $100 every year. So your value in the current moment would be that $100 you already earned during that year, plus the $1,000 of future value. In total, that means the value at the current day would be $1,100. Okay, so now we're at the end of the year. The company has two choices, dividend or buyback. Which one is better? Dividend, buyback. So we have our warring sides of dividend versus buyback. In order to do the analysis, let's assume there are 50 shareholders who each own a share. So that means there are 50 stocks in total outstanding. The company earned $100. With 50 stocks, that means they could declare a dividend of $2 a share. Okay, so they decide to do that, and now $2 is in your pocket. Each one of their shares now trades at $20 because we have the $2 in our pocket and the stock is now worth $1,000, all based on its future profit. And 1,000 divided by 50 is 20. So at the end of the year, your value is $22, again, assuming no taxes. Now, what happens? What if the company did a share buyback instead? Well, at the end of the year, the company would have $1,000 of value, as shown in the formula, plus $100 of excess cash. They value the stock at $1,100 divided by 50 shares, or 22. Now the company uses that $100 to buy back its shares at $22. $100 divided by the 22 price would mean they could buy back 4.54545 shares. Let's just assume that they can buy back fractional shares. After this buyback, the company has a value of 1,000, but they only have 45.454545 shares. If you do the math, 1,000 divided by 45.4545, that's exactly 22. So you could see in both ways, in theoretical purposes, it is the exact same value. However, this was pre-tax. What happens post-tax? Well, Uncle Warren Buffett had an interesting quote. Let's pull up his 1990 annual report. Buffett said, "When Coca-Cola uses its earnings to repurchase its shares, the company increases our percentage ownership. Instead of repurchasing stock, Coca-Cola could pay those funds to us in dividends, which we could then use to purchase more Coke shares. That would be a less efficient scenario because of taxes." So this is an interesting point, that a share repurchase is always better for the person who doesn't sell a stock, because if you were to get a dividend, you have no choice. You have to pay the taxes right away. But if you do a share repurchase, then as an individual shareholder, you only have to pay taxes at a future date. But what about all the shareholders as a whole? Because we should think about this as, who's paying more taxes as a whole, not just as an individual shareholder. If we pull up what the US tax rates are, and we're just going to use the highest possible tax rate for both examples, the highest possible tax rate for dividends is 37%. And for capital gains, it's 20%. That means on that $100, the government will take $37 and put it in their pocket. However, for a share repurchase, only 4.545 shares were repurchased, and they were sold at a gain of only $2 a share, because all the shareholders started the year at $20 and at the end they sold it at $22. So that means a $2 gain times 4.545. That's only about $9. The capital gains tax is only 20%. That means they're only going to record $1.8 given up in their money. So Scrooge McDuck and shareholders would be very happy with this situation. Instead of having $1,100 minus $37 at the end of the year between the whole group, which is $10.63, now the shareholders have $10.98, which is 3.2% more than $10.63. Share buybacks are a much more efficient solution as a whole and as an individual. This explains why buybacks have significantly outpaced dividends since 2004, and explains why companies will continue to use it. This is despite a lot of people claiming that, we need dividends, we need buybacks. Really, you want your company to be buying back stock rather than dividends. Oh, but what about an overvalued stock? The market is open. What about if the shares are overvalued? Well, first of all, it doesn't make any sense for you to be owning a stock that's overvalued. So that example doesn't make any sense, that you shouldn't do a buyback because the stock is overvalued. Well, if you thought the stock was overvalued, why are you in the stock? If it's undervalued, then obviously you should be in the stock, and then it's even better. But let's just pretend that the stock was overvalued, and for whatever reason you knew that, and you just decided to be in the stock. So let's say in our $22 scenario, the company were to buy back its stock at twice its value, or at $44. This means it could buy back 2.2727 shares. So that would be that $100 divided by $44 a share, and that's how we got that number. Then there would be 47.7273 shares outstanding, and the value for each stock would be that $1,000 divided by 47.7273, or $20.95 a share. Therefore, over the years, the investors gain 4.75%. So those investors are just the investors in the company. If we consider all the investors as a whole, again, it would be around that 1098. Sure, they would pay, a bit more capital gains this time. It would be about $11 in capital gains this time. So that means at the end of the year, all the shareholders in total would be left with $1089, which is still significantly above that 1063. But let's just only look at the shareholders who decided to stick on and stay with the company. So at the end of the year, they would have $20.95 compared to the beginning stock price of $20. That's a return of 4.75%. But if they were to be paid dividends, they would get a return of only 6.3% because that's the 1063 divided by their original 1,000. So even if the stock is twice overvalued, shareholders only lose a little bit more when the company does a buyback over a dividend. So wow, we can really see the example that dividends are kind of garbage and buybacks are a lot better, mostly because of the tax man. The US government is not taxing dividends and buybacks at comparable rates. As shareholders, you should be taking advantage of this tax inefficiency. I understand that it's great to have money in your pocket from dividends, but in reality, you could just sell parts of your stock and activate the capital gains as a more efficient way. But now that we've seen a lot of brokers lower their commissions to zero for trades, it makes buybacks and selling stock as a better way to generate income than for a company to use dividends. It's not a surprise that we see many politicians villainize buybacks and not dividends. We've seen Elizabeth Warren, Bernie Sanders, Cory Booker, mostly Democratic politicians, villainize it as being anti-worker, but you don't really see them come out against dividends. This is likely due to the extreme tax efficiency for shareholders of buybacks over dividends. And next time you see a politician come out against buybacks and not dividends, are they saying buybacks are anti-worker because you get to keep more money? Or are they saying it because they get a smaller amount of the tax payment to themselves? If you like this video, please hit the like button and subscribe so that we know to make more financial education videos like this one.